Morning, Lee. How are you? Sorry, I just got my coffee. I'm still in process. Still sitting on the sidelines? Okay, I do have, I think I'm going to talk about it in terms of sitting on the sidelines. You are not alone. There is almost $6 trillion sitting on the sidelines. So, yeah, there's a lot of money still waiting to be deployed. Um, Essentially because, if you can get risk-free 4%, 4.5%, why take risk? So that's currently what I'm seeing in markets. What else? So today I do want to few things that I have in mind I'm prepped up for is we'll look at some of the charts and see if you know are we in a bubble? Means is it bearish or are we in a start of a bull run? So you make a decision. I'll share some charts that I've seen floating around. Uh, Also ties to Nvidia versus Cisco. Is so we look at that. Plus, of course, a few earnings. CrowdStrike, Sentinel One, Oracle, and Adobe. Adobe like had a really bad move after earnings. So we're gonna dig a little deeper into these earnings. And last week, I think was it Ramesh who said there's Barron's had a bull case for Mercado Libre. So I'm gonna quickly run through some salient points on that. Um, those who have been around for some time in this session, you guys know Mercado Libre is currently, as of end of last month, where I shared my portfolio. Mercado Libre is my single stock biggest position. I'm still happy to hold it. Yeah, those are the things. Unless there's something else that you guys have in mind. What else you want to talk about? 5.4% in 3-month T-bill. I didn't recently check. Is it T-bill now yielding 3-month yielding 5.4%? Is it on a new auction or is it from a secondary market, Lee? Let me just check treasurydirect.gov auctions, recent auction results. 20 most recent auctions, 4-week, 13-week. Yep, you're right. Even the new ones, I think the one which was recently issued, sorry, 3 months, that will be 17-week, is like 5.375. I don't know, is it one of my treasuries got matured mid of maybe 2 weeks ago or maybe a week ago, and I haven't laddered back in. Let me see. Since I talked about treasury, let me see if anything 1752 week is coming up near time. So 314. So I'm already, can I still buy this? 26-week. Auction date is 318. So and maybe I'll rotate my 17-week, which got matured into 26-week. It's 318, right? This year I haven't been that aggressive in rotating or reinvesting the treasuries because I'm putting that money to work. But looking at and my thought process was that maybe the rates will come down, but looks like it may not. So might as well still keep. Oh, sorry, let's go to the recent ones. What was 26-week recent? 5.3 works for me. Yeah, even money market will get you 5.1%. Yeah. So that's where I'm holding. Yeah. So the other reason why instead of like putting in, I buy directly from Treasury Direct. Now what I did last month is put it in a 3-month T-bill short ETF, short duration 3-month T-bill ETF, ICSH, and it'll give you basically dividend every month. And that I bought in my brokerage account. If I need to deploy it, I'll just sell it. But yeah, treasuries are still doing good, still doing good. All right. Anything else? Any other findings before we jump into today's session? Looks like the higher for longer is gonna stay here for much longer. No more 7 rate cuts. When we started this year, market was predicting 7 rate cuts, then became what, 5? Now only 3 rate cuts. Now I think we're predicting, hopefully there will not be any rate increase from Fed. See how the narrative changes after a couple of, not even just, I think just one producer inflation index rating, and the narrative in the market has not changed. But anyway, looks like, let's look at the weekly performance. Not that bad, especially, I mean, I still see more greens than reds. How did S&P do? Let me just pull up on an overall different index perspective. How did the market do on a weekly basis? So let's get weekly market. Uh, Not a big change. I mean, not even a percent move, or probably a slightly more than percent move, but still at the end, year to date, 7.28%, still good, right? But if we hear tune into CNBC or Bloomberg and all that financial media, you'll probably realize we are in a bear market. Things are looking really bad, but no, it's 7.28%. We are like 2.5 months into the year. I would say that's pretty good. One big change is that the Nasdaq overall is actually underperforming S&P 500. When did that happen? I mean, we don't see this Nasdaq underperforming in case of bull runs. We have seen Nasdaq underperforming overall bigger market in case of bear runs. When the markets are not doing good, Nasdaq generally will fall more than the S&P 500. But this year, Nasdaq is actually trailing S&P 500. And of course, one big part of the Nasdaq was Tesla. And if you're owner of a Tesla, yeah, Jay, exactly. That's what I was coming to is, if you're owner of a Tesla, it's been a tough, 8 weeks to own Tesla. Tesla is the worst performer in S&P 500. I think it's down, what, 35% for the year? Where is it? Yeah, 34.16% for the year. So I shared this on Twitter that now Tesla is back where it was, in April of last year. So almost 1 year worth of gains, or money. If you had money in Tesla, it hasn't done anything for past 1 year. Yeah, that's a tough situation for Tesla shareholders. But yeah, I've been building my position in Tesla. I never held Tesla, but over the past 2-3 months, not even 2-3 months, and maybe Jan or Feb kind of stuff, I've been building position in Tesla. And why not? It's better to buy Tesla at 180, 170 than to buy it at 300. So, all right, Tesla has been dragging S&P 500. What's been keeping up Nasdaq and S&P is Nvidia. This week it didn't perform, which is strange. Come on, isn't Nvidia supposed to go only up? I thought that was like unwritten rule in the markets is Nvidia and SMCI. They're supposed to go only up, but not this week. I mean, it was barely up, I should say. But good to see, Apple coming back. Google was one of the big performers. It's up like 4.3%. I'm not sure what was tailwind, or what was the driver for this news? I didn't see or any new releases from Google. Maybe the sentiment was really very bad. But yeah, nothing. I would say nothing much to write about for this week. A couple of individual stocks that we're gonna go through. Oracle was up like 12% for the week, and the earnings market really liked the earnings, whereas when it comes to Adobe, market didn't like the earnings, especially the guidance. I mean, they beat top line and bottom line, but market didn't like the guidance. So we're gonna go through those earnings, and I guess Broadcom, AMD, I don't even know what's driving these on day-to-day basis. It's more of a sentiment driven than anything that has to do with the company itself. So that's a quick. And Tesla is down for another almost 7% for the week. Tough days on Tesla.
Vivek,
Yeah,
a few weeks ago you bought a Bitcoin trust, right? Do you own Bitcoin?
I do own, as well as I own Bitcoin Trust. I mean, I don't own the GBTC anymore. I sold off and moved to ETF.
Well, okay, the reason being was because I sent you a news story. They're still negative on cryptocurrency in general, but they said as a result of these trusts, 200 Bitcoins are demanded, but they can only sell, I think it's 200. That might be incorrect, but they can only sell 95 Bitcoin per day. So, in other words, there'll be a supply of Bitcoin for more or less perpetuity.
No, so here's the deal. I think the numbers are a little off, but I don't know. I think what's and the demand of a Bitcoin depends on how much of the money is flowing into these ETFs. So we and
Uh,
I've seen, yeah,
so it was more than twice. There
yes,
was more than twice as much. Sorry about that. There's more than twice. Uh, uh, two times. They're only able to sell or buy 95. All the trusts can only buy 95. That's the supply, and there's over 200 in demand to be purchased because of all the money coming in.
that is true. The number of, I think there's a little nuance over there. The number of Bitcoins that are being produced today is 900. Um, because let me say it's what 6.25 per 10 minutes. Yeah, I think it's 900 per day.
Sorry.
And in come April, I don't remember exactly what's the date of that halving, that the supply will be cut into 450. And there is right now, based on the amount of net inflow into these ETFs, the demand is more than 900 Bitcoins. So even if miner sells everything that they produce every day, ETF issuers still have to go and hunt for to buy additional Bitcoins, and those would come from those who may be holding it. So I think that's one bullish thesis, and those who are bullish on this one, they're also saying that come April, let me see what's the expected Bitcoin halving 2024. Come April, when will it be? Okay.
Sorry, I don't recall how much, but I thought the supply was for a good decade or two.
Yeah, so it's 39 days, 17 hours. Expected halving date is April 25th. So the date is not exactly which the it actually goes by the event block. So at 840,000 block height, there will be another halving. And on an average, there is one block created every 10 minutes. That's how you work out, okay, if I need to go to 840,000 blocks, it will take another 39 days, right? So give or take day plus or minus, it's around 25th April, plus or minus a day, the supply of Bitcoin will be cut into half, right? And now the expectation is, if it was any other asset, if the price goes high, the miners or the producers of the asset will basically invest in the business and increase the supply, right? Look at the oil, right? Over the last 20-30 years, the demand for the oil and the consumption of the oil has grown multifold, but the price hasn't really grown that fast because if the demand goes, the price goes higher, the producers will produce more competition will come in, and hence supply becomes higher, and then again, basically supply and demand matches. In case of a Bitcoin, you just can't increase the supply. So I think that's because it's gonna get halved in April. Doesn't really care what the price of Bitcoin is, and you really can't invest more and improve your mining hardware to generate more Bitcoin, because the moment you add more hardware, the difficulty level of mining increases, and hence the number of so basically the number of Bitcoins that get created or generated is still going to be every block whatever after 3.25. So that's the dynamics, and that's why you see some you know outlandish estimates from Bitcoin bulls on where the price could be, right? So, but short term, anything could happen. I think the Bitcoin was down. Let's go to crypto and if you look at the crypto side, it is down to now 68. 3 days ago, maybe, or maybe 2 days ago, it was like 73K. So this is still a very volatile asset, and a lot of leveraged players are in it, and it is pretty common if to see 10%, 15% drops, at the in a day. So if you are coming and you have never had any exposure to the crypto side, but if you're only have dealt with ETFs, uh this might give your heart it might increase your heart rates by a lot. This is still a very volatile space, because there are exchanges that will allow, not in US, but there are derivative exchanges outside US that will allow you to take a leveraged exposure of 10 is to 1, 100 is to 1, right? And when everyone is looking at, oh my god, halving is coming in, I want to just load up on it, people go and take like 100 is to 1 leverage. 1% drop in the Bitcoin, your account gets liquidated. So we see these mass liquidations, leverage liquidations happening very commonly. So even I think when it dropped from it went all the way to what, 67, 66, I don't recall what the exact number, but almost $300 million of leveraged trades were liquidated. So this is still pretty volatile. Hopefully, as more the assets on the ETF, um, increases, and more traditional investors start to take exposure to this, probably we may see volatility reducing a little bit, but for now, still very volatile. So if you are gonna, you wanna play in this, just make sure your position sizes it accordingly. And I was in, and now I see, I think till now I've been saying that I'm not seeing many retail investor getting FOMOed into crypto just yet. Uh, this bull run has been the least celebrated bull run on the crypto side, because no one is talking about it. You don't see big screenshots of crypto gains, people talking about Lambos and all that stuff. And from this week, I think those vibes are coming in, especially in meme coin stuff. So I thought I'll talk about this because I also, every Tuesday I attend a meetup around crypto, and after now almost after 2 years, now we had more folks who joined it, and they're talking about some meme coins. And I was like, okay, now it started. We are going back to 2021 time wherein everyone wanted to talk about Dogecoin and all that. So someone was, and not even I think retail, even I heard uh, um, Raul Paul, the macro guy, operators of Bahamas. He's big in a trad 5 plus being in the crypto for quite long. He was talking about this what dog wife, dog with F hat, whatever it is, right? And now people talking about how they made like 400%, 500% in this one. See, like 17 cents hitting like $3. So I think a little bit of FOMO is setting in, but I think we are still early in this game. So, but you will see a lot of these like meme coins, fun coins, if you are in Twitter or YouTube, now being paraded by influencers and all that. And just don't get into FOMO. These are uh, digitized version of pink sheet stocks. That's all it is. It's all pump and dump. Some will, some might have a longer life than others. Like Dogecoin is still surviving because Elon Musk keep pumping it up. I think Shiba Inu is still around. Many of these will just disappear. So, but that doesn't stop people from trying trying their luck by buying some lottery tickets. Yeah, go ahead and try it if you want to buy a lottery ticket, but understand that it is a lottery ticket. So that's what's happening on the crypto right now. Since we talked about crypto, a quick update I mentioned last week. Everyone is focused on Bitcoin, but Ethereum went through one of our biggest upgrades in over 18 months, and that has reduced the fee on doing transactions on Ethereum, especially L2 chains, by over like 90%, 95%. So I still expect to see a lot more projects coming in because now the fee on Ethereum has become much cheaper. So probably a lot more developers will develop on this one. So that's a quick update. That was one of a big update after almost 18 months. Denken upgrade. If anyone is more interested, we can go through what are the EIPs and the Denken. But I'm not sure, that will be probably getting into the weeds. Lee says utility is coming back. Where is XLU? So I'll be surprised because generally if the interest rates goes higher, that is, I see utilities generally will take a hit on an increase of interest rates. But if the question is, I guess where was probably when Jerome Powell came and told that they will be looking for a cut. We don't know what the timeline would be, and we saw even stock market, Nasdaq as well as S&P went up. But if we are looking at the rate higher for longer, or not getting as many cuts as the market is expecting, then the utilities won't be good for utilities. Because if I can get 4-5%, I mean the whole point in investing in utilities is they give a constant dividend. They're a good dividend payer because they have a predictable stream of income, so they can pay you good dividends. But then you run a risk of investing in a particular sector. If I can get a dividend of 4%, 5% by almost risk-free with treasuries, then why do I want to invest in utilities? Right. Number two is increase. Many of these utilities have a large amount of debts because they have a predictable income, so they'll take on debts to basically juice up the return on equities. That's a way, a lot of CEOs will figure out how to increase the EPS. And if interest rates continue to stay higher, and they'll have to rotate their debt, that doesn't bode well for them. So I'll expect if the market thinks that interest rate is going to increase, then utilities will probably underperform. GBTC replaced by no, GBTC. No, what I was saying is that I replaced my GBTC holdings with the ETFs, but GBTC is still around, and they still have how much under management now? Oh, it doesn't show me. This one to AUM is $26 billion. Even though they have seen massive number of outflows from GBTC to other ETFs, just mere fact that the Bitcoin price has increased, I mean, GBTC continue to mint money on this one. So they got to like today, what they have $26.6 billion under asset under management. They have what 1.25. They reduced their fee to 1.25 or 1.5. Let's take 1.5%. That itself will bring in almost $300 million plus for just custodying it, right? Yeah, but GBTC has now filed another application for some mini trust which will have much lower fee. I haven't gone into the details of that one because okay, I'm not even interested in that. But looks like they know, you know, how long will people continue to own GBTC? I mean, there is no reason to own GBTC unless it is for tax purposes, right? If you are holding GBTC in your taxable account, and if you have to sell that, you're gonna get a capital gains tax, right? If you had bought GBTC, let's say 2 years, 3 years ago, and you don't want to take the capital gains tax right now and pay 26, whatever the tax slab to the IRS to avoid 1.25, 1.5% of fee. That's the only reason why GBTC is still having and holding it, and they knew it that many of the holders probably are holding it in their regular taxable accounts. Those who are holding it in a non-taxable accounts, retirement accounts, there is no reason to hold this GBTC and pay 1.5%, right? So I rotated into ARKB. They got what 21 basis points. Lisa, it will take huge amount of electricity to make Bitcoin for a Bitcoin and AI utility is looking good. Yeah, but I don't know how do I translate that into which I mean, if you're talking of for the traditional utilities or you're talking renewable ones, or overall, I think we will have a higher we'll have a need for more electricity. But I'm not a big, I mean, I don't focus much on the utility sector, but I don't know how that will translate into should I buy Nextera or should I buy, Edison or Duke Energy. That's something which I am not really sure of who's going to benefit from them. Utilities are insured by local governments, but they also are kind of, it's a regulated space. They can't increase their rates and benefit from the demand, right? Like look at NVIDIA. There is a AI demand for the H1000 chips. Like they're making like 55% net profit margin. They can just skim their customers. Utilities can't do that. Sorry, there was a comment. Okay, maybe some background noise. Anyway, so yeah, I mean, for me, utilities is a dividend play. Let's look at XLU. What's its XLU dividend yield? And if I can get a nice dividend from what's dividend yield is 3.38%, which is good. But when you start to compare it with what 5.34%, that's where I'm saying, maybe I'll not, you know, mm, I'll probably stick with treasuries or whatever. Yeah, so looks like XLU's biggest holding is Nextera, then Southern Company, Duke, Constellation. Yeah, if you don't understand the utilities individual company, I mean, I have traded XLU earlier. I don't think I held it as my long-term ticker in a portfolio, but it's a liquid ticker and with a good option volume. So just from a diversification perspective, I had traded XLU earlier. I don't have it anything now. All right, let's what else? All right, let's jump into today's session then. Let's talk about are we in a bubble or in a bull market? What do you think? There are pros and cons, there are arguments on both sides of the house. Something we are in bubble, something, oh no, we're just starting on our bull market. So I'm going to present a few facts, then you guys can decide what you think. So today the valuation, and this is talking about overall market valuation, like S&P is 20, almost 21 times forward earnings. That's too high because on an average, long-term average of S&P is between 15 to 16 times EPS. 21 is high, right? Median PE of the 10 biggest stock, like top 10 stock, is higher than in 2020, 2010, and even the dot-com bubble peak. So probably we are in bubble. Frothiness is showing up in a pro-risk asset like Bitcoin. We just talked about it. So it's like a risk on environment. Bitcoin is up, I don't know, probably is up much more than 50% year to date. Well, let's look at, well, let's get to the BTC and says what's, oh, it gives me 1 year. It doesn't have YTD. All right, so maybe we were around close to 44, and now we are close to 68. Wow, Schiller P is now 34. Uh, that's pretty high. This is Cape. Yeah, this is Cape. Yeah, so which is again pretty high from so on 2000 you had it close to 40s. Now it's already 34. So that's one more argument in favor of, hey, looks like we are in bubble, right? So time to be bearish. Stocks like SMCI are up 20x in a year. Market is highly concentrated, right? It's all AI stocks. And now we are seeing some AI new or AI investment vehicles coming out. I'm going to talk about that. That also looks like that we are in bubble right now. Now, some arguments in favor of bull market. GDP is growing nicely. Right? Guys, the economy is growing, so does the market. So if economy is not growing and only the market is growing, then yeah, that's something to be concerned about. Right? Inflation data wasn't bad. EPC was good. I know the producers' inflation numbers were higher than what we expected. Market concentration is nothing new. Market has been in concentration phase for years. Since 1998, S&P has returned 300%, whereas average was up only 17%. So all the 300 is coming from the fewer concentrated, bigger stocks in the S&P. And because S&P is a market weighted stocks, the bigger the stock becomes, the more is the weightage, and this becomes your uh, you know um, uh, flywheel. So bigger it becomes, momentum wise, more money comes in, more is the impact of that particular stock. Next one, long only mutual funds, they have hedged their downside risk by keeping the exposure to the economically sensitive stock to the nearest lowest levels. So the economically sensitive stocks, consumer stable, not the stable, but let's say consumer discretionary, etc. Long only mutual funds have the least amount of exposure in there. So it means they're already hedged. So they're waiting for the bull run. Now the average bull market since 1930s have lasted 694 days. The current one, it started only in October 2022. We are like what, 400 days? So we probably are in the middle of a bull market. Who says that we are in bubble? Right? Looking at these arguments. A chart from Stratigas. This is a Wall Street firm. Only a few. Okay, so let's look at this one. What does this shows? So this shows percentage of the stocks at 20-day high. Right? And this is the S&P 500, 50 and 20-day moving averages. Now, the percent of stocks at 20-day high, historically very rare to get 70% of the S&P at 20-day high. But we just hit that, very recently in December. But this is also it is common that the market corrects after that in a short term, but in a long term, it's a very bullish signal. So maybe short term bearish, long term bullish. I don't know. Well, let's look at some other charts. This one from Bloomberg. Right? Is the market overextended? We haven't seen a 2% drop in the market now almost for 265 days. So only it happened last time without getting a 2% drop was in 2018, wherein there was no 2% drop. Sorry, in 2017, no 2% drop for almost a year, 350 days. And now we are approaching almost 265 days. So maybe, is the market overextended? Maybe or maybe not. This is another interesting chart. Stocks that are up 100% year over year with a PA, price to sales ratio greater than 10, right? Not nearly as frothy as .com or in 2020. It is going up, but still much lesser than the other years. So this is pretty common. I mean, we've been in this situation. Looking at this chart, we've been in this situation forever. Right? Nothing uncommon about it. Another one from Carl Candelia is an anchor at CNBC. BUFA equity allocations today are almost precisely where they were in 1995. So we are not in 1999 euphoria. We are in the start of a bull run of 1995, right? So when you look at, and we're going to look at some charts of NVIDIA and Cisco. The bigger question that I think investors are asking, is NVIDIA parallel of 99 of Cisco, or is it 1995 of Cisco? Right. Now, looks like BFA had a study where they're looking at overall all the stocks, and they say, guys, the allocation on the stocks is still in 99, the way the equity allocation was in 1995. So we aren't there yet, wherein, it's above this red line. We are right in the middle of this extreme bullishness versus extreme bearishness. Right? Wall Street Journal article, I was reading through it. So almost 1/5 of S&P 500 hit a new 52-week high. So now it's no longer concentrated, and this has been the largest share since 2021. And if you really look at this S&P and equal weighted S&P, which is RSP ticker, we're catching up. Right? It's not only just the big tech, because we've seen Tesla is down, Apple didn't do much for this year. Where is Apple? AAPL. Last couple of weeks have been amazing weeks wherein Apple is down, market is up. Apple is up, market is down. So Apple is down 7% for the year. Let's look at the other ones. Google or Alphabet is up only 2%. So that's not driving. Meta is the one that is nicely up 40%. Tesla, we looked at, is down 35%. What are the other? Microsoft, 12%. So many of these biggies, they're not driving. It's a NVIDIA and maybe a bunch of other non-techy stocks. So looks like 20% hit a new 52-week high. So the rally may be broadening, which is healthy for a bull market. We don't want the market to be very concentrated and driven by only handful of stocks, like AI only stocks. That was the case, but over the last 2-3 weeks, not any longer. The rally has been widening. We saw utilities, they have also performed. So is it a bubble? Is it a bull? I have no idea. You guys can decide. There are arguments in favor of either side. Maybe you're in a bubble, maybe you're in a bull. The reality is no one knows. And I belong to the camp of no one knows what's going to happen in short term. But I know one thing, that if you own some good quality companies with good management, doing nice, better capital allocation decisions, companies generating revenue, have positive EBITDA, generating cash flow, long run, this will work fine. Short run, anything could happen depending on what's the mood of Mr. Market is, right? Uh, we talked about earlier sitting on the sidelines. A chart from Strategas is amount of a money that has flown into the money market mutual funds. So this talks about composite net flows into ETF plus mutual fund vehicles. So the red one is money market funds. Green one is a bonds and blue one is equity. So as you can see, since this is like end of December, so over the last 40 years, and obviously because the interest rates have increased at a pace that we have not seen in last 40 years. So a lot of money has flown into money market funds. Look at the pace at which the inflows have come into money market funds. So these are some of the best selling vehicles for the last 40 years. And another chart looking at the assets of our money market funds, overall 6 trillion. 6 trillion assets still sitting on the sidelines, out of which 2.4 trillion is from retail investors. People like you and I, maybe we will allocate, maybe I'll hold something on treasuries until I'm more comfortable. Or maybe it is in a bubble. I don't want to invest it at this when the markets are all-time high. I'll hold it on treasuries or hold it on a money market funds, right? And maybe I'm just a very conservative investor. I don't have to hit it. Don't want to target for 10%. I can get 5%. I'll be very happy with it. You know? Why do I have to worry about it? My life goes good. I don't have to get up in the morning and see what the heck Nvidia did today. Yeah. So yeah, almost 2.4 trillion of retail is sitting on the sidelines. So if it is actually a secular bull run and we are just getting started like in 1995, or we are in a half middle of a bull run, because we're close to 300 days, and generally on an average bull run is like 700 days, then that money will start to flow in. People may start to get a little bit of a FOMO when you see your friends getting, talking about how they made like 10%, 20% over a year. And you're like, then maybe 5% doesn't look that attractive. At the end of it, it's a human nature. And eventually, even the institutional clients will start questioning their money managers on, I made 6%, or maybe holding some corporate bonds. I made 7%. The market was up like 18, 26% last year. If your market goes up another 10%, 15% by mid of a year, there will be questions asked of those portfolio managers on why the heck we should invest with you. So short term, no one knows where it will go. So I was listening to the CNBC while I was working on the kitchen, and I saw another FOMO coming in. This is a CEO of Fundrise. I knew about Fundrise because they allow you to take exposure into real estate without owning a real estate. Basically, it's kind of a REIT. And now they have come up with another fund which will allow you to take exposure to unlisted companies, like private companies. There are already such vehicles which exist. But and I was like, what capability does Fundrise has? So great thing is that the anchor asked them a question on, what makes you think, that you could do well on the AI. What's your expertise on AI? Because you spent 10 or what Fundrise is almost 10, 12 years old, and all they have been doing is a real estate. And the answer from the CEO was, and I burst out laughing, says, we have 150 software engineers. and we've been building software for last 10 years. And I was like, what? And again, I think what at the end of the day, his summary was there are investors who want to get exposure to a private companies dealing in AI because over long term the VC funds perform much better. I don't think that's factually correct. But anyway, he's there to sell his you know sell his goods. So he was like, so we have created a fund, and now this company Fundrise have taken exposure into Anthropic and some of the other private companies in the AI. So remember 2021 Long Island blockchain? When blockchain became the rage, we saw Ice-T company changing its name to Long Island blockchain. We saw Kodak coming up with a Kodak coin, right? So now I'm seeing a fund rise whose expertise has been in the real estate, suddenly coming up with a fund which is going to invest in AI companies, right? So yes, be careful. And companies will create, if there is demand, they will create these vehicles because they don't lose anything. He's gonna make his, the whatever the carry. I don't know whether they have a carry or just a fee. I think what he mentioned is they just charge a fee, and no carry means no profits, no percentage on profits, but 1.5% of the asset under management. For them, it's like a free money. If you invest in it and the AI bubble burst, it's your money, you lose the money, right? They still make 1.5%. So, and I expect to see few more. I mean, this probably may not be the lone wolf in this, uh, but I just happened to hear about it because CNBC was playing in the background. I see a question. Do you make use of any leverage ETF, QQQQ, or leverage sector ETFs? Nope. Now, there is a reason why I don't make use of leverage ETFs. I think I've spoken umpteen number of times. The reason is leverage ETFs are not to be inventoried, means not to be held longer than maybe a day, max a week. When I'm looking at getting an exposure, I'm looking at a little bit longer term than a day or a week, because the volatility, if you take any leverage, and I'm not even talking about QQQ, any leverage ETFs, if it is a volatile sector, the volatile will just kill the returns on the leverage ETFs, even though your thesis is correct. So for example, this is what I want to say. So you picked any ETF which is at underlying is at 100. You're bullish on it. You want to hold it for a month, right? But you took an exposure through a leverage ETF which is 2x leveraged. The stock is at 100 or the underlying is at 100, and it closed after 30 days at 120. But from 100, it went down to 90, 80, 70, 80, 60, 85, 90, 100, 105, 90, and then 120. Your leverage ETF will lose a lot of money because there's a lot of volatility. So this is a point that you need to understand. Anyone who is investing in leverage ETFs need to understand that the volatility is a nemesis of leverage ETFs, especially if it goes against you during the initial phases. We ran some simulations on Google Sheet, right? Was it last year somewhere? Maybe I can find that, wherein like we look like 30 days, 2 weeks, the majority of the days were bullish, and the leverage ETF still lost money, even though the underlying was moved in the direction of our thesis, but the leverage ETF still lost money. So that is why I don't invest in leverage ETFs. The instrument was created for professional money managers, institutional money managers who want to hedge their risk for a very short duration of a time, right? If I've got a lot of long deltas, I want to hedge for, let's say, Jerome Powell is going to come on to the do a press conference, a market could move a lot. I may want to hedge my risk at by investing a small, maybe I'll take that leverage bet. So that's the purpose of creating it. But a lot of people get you know FOMO'd into investing in leveraged ETFs, thinking that invest one, you can make two. But majority of the time, if you hold it for a much longer period, you invest one, you'll end up with less than one, even if the underlying is gone higher. It's a volatility that kills it. If there is no volatility in the asset, great. But that's the reason I don't do any leverage ETFs. Hopefully that answered question. Speaking of non-tech, any thoughts on McDonald's? I haven't never looked at McDonald's. So, but while we continue our discussion, let me see if I can actually, hold on. Let me try to. What's the McDonald's ticker?
MCD.
MCD. Okay. I'll just try to pull in some data for MCD while we discuss, and then I can look at McDonald's. MCD. Okay, so we'll come back to McDonald's. What do you think of MSTR? So I still haven't been able to figure out in terms of how is Michael Saylor able to, just so first of all, those who don't know about MSTR is a ticker for MicroStrategy. It used to be a data analytics company, but now completely focused on Bitcoin. It's a proxy for exposure to Bitcoin because institutional investors were not allowed to buy Bitcoin directly and there were no ETFs. The only way to get exposure to Bitcoin was to buy MicroStrategy stock because MicroStrategy is the biggest biggest holder of Bitcoins on its balance sheet. I think now they are almost equal to no, not equal to Grayscale. But anyway, this is the biggest holder. And Michael Saylor, he's been selling basically all he's been doing is raising the convertible debt from investors and investing that in Bitcoin. I mean, he did like 800 million a week prior, and this week he announced another 500 million. Um, so Shri, if the idea is to get exposure to Bitcoin, I would say it's a high beta exposure to Bitcoin. So it it moves way more than the underlying Bitcoin. So if this is up 160% for the year, and we saw this whole huge jump off on Friday because of announcement of another $500 million worth of convertible debt. But I've not yet gone into the details of what kind of risk that poses, because all he's doing is he announces his convertible debt, stock price goes higher because everyone knows he's going to get that $500 million and he's going to go and buy the Bitcoin, right? So means more demand for a Bitcoin. And then when there's more demand for a Bitcoin, all he does is, this also push up the stock price because more people want to get exposure as a proxy to this. He does, again, either he'll do a convertible debt or do another stock sale and then go and buy Bitcoin. Right? I don't know how long that continue, but I'm still not able to understand what kind of risk will I. Of course, the one big risk is, if the market turns southward, that's one big risk. But now with the ETF being available, I don't know how long can he play the game. So that's I'm not I don't have any exposure to micro strategy. If I were to take an exposure, I would take a bearish exposure or to just hedge the my exposure to Bitcoin ETFs. But this is a high beta exposure to Bitcoin. Seems to me that is a scam like Madoff. No, I mean, I don't think it's a scam like a Madoff, but you can't just keep doing this. I mean, it works until it stops working. And it's been working because Bitcoin has been on the, uh, on the northwest trajectory. So, but the stock has been pretty volatile over many years. So if you look at, uh, wow, now it's like 1800. Yeah, this was his highest in 2020. This is where he started buying Bitcoins, and now it's about $1,800. Yeah, I'm not very comfortable in going long on this one. Oh, by the way, I'm about to finish a book on basically written by an ex SEC chairman, and while I was reading through the book, there was a reference of how companies mislead investing public or do some shenanigans. And he had a prime example for micro strategy. I thought I'll tweet it, but let me just finish the book. I do want to tell you, I didn't expect, but it looks like it somewhere in during the .com, Michael Saylor and his cohorts, they had inflated their revenues and all that stuff, and was indicted by SEC and had to pay fines to SEC, and basically corporate malfeasance. But if you're a stock shareholder, who cares? Nobody asks any questions if it keeps going up, which is happening with it right now. So anyway, so we talked about crypto FOMO. Also looking at the market performance, S&P 7.28%, communication services, which includes Meta, largely driven by Meta, is up like 11%. Fear and greed index is still in the greed phase. And yeah, so this is a time I want to go big overall market when the market is in a fear mode, right? Until then, I just reduce the cost basis, keep an eye on deltas, and just you just reduce your deltas. Don't have to do anything crazy. Oh, I didn't check up earnings next week. So what did I buy or sell this week? Again, this is not a recommendation, but I just want to be transparent of the stocks that I transact, because we do talk about stocks. So I bought Nanox, Mercado Libre, Tesla, Apple, and again, not that I became super bullish on any one of these, but some of these companies I find, except Nanox, that's a little different story. I sold it I had some Nanox in my retirement account. I sold it when it jumped on that AI hype, and now I bought it back in my brokerage account. So that's just like moving from one account to another. And now it came back down after that hype. So I'm like, okay, I can buy it back and get the same amount of exposure. Mercado Libre, I don't know. I mean, market gave an opportunity. The stock fell down for some news which CEO already told that they're gonna do this thing. So I thought that was an overreaction, took an opportunity to buy one. Tesla, I don't have to talk about it. You guys know Tesla has been one of this is the worst performing stock in S&P 500. So it's time for me to build position in Tesla, because Tesla is also, even though the stock is the worst performer, it is still number one on option trade. So the options are very liquid. It's easier to reduce the cost basis on Tesla. So I don't want to build an option, or build a position and then start reducing cost basis. Apple, yeah, looks like market is given Apple for dead. They're saying this company has no future or this lost the race of AI. Apple just announced acquisition of a company in AI, I think Darwin AI. It's a Canada-based company. I haven't delved into the details of that, but Apple generally doesn't do money acquisitions, right? So I will check into the details, but I think it was at a price point where I said, okay, let me add a little bit more to my position. And sales on the Disney and Jumia Technologies, both are covered calls. And I thought, okay, let them get called away. So that's not an issue. Any other questions? You're planning to buy stocks or options in these buys? Oh, these are the ones that already bought this week. Options are different. I mean, options, you can see my open option trades. I think I shared it. The link is there on the website. Let me just bring it up of where you can find this. So you can see all my open trades on option over there. But these are the stock changes. Okay, another question. Amit says, how do you go about building position? How much starting percent? How much add overtime max based on? Great questions, right? So here's my thought process, and I keep on refining it. So once I initially find a company that I want to keep on my radar, I'll just take very small position, right? Like not even like maybe 0.1%, 2%, so that the ticker is there on my brokerage platform. And I know, okay, someday I have to go and review this. So that's how I'll initially start it. And then once I review the company and I think, okay, I do want to get an exposure to this, then I'll start with a 0.5% exposure to between 0.5% to 2% exposure as my initial one. I generally take 3 or 4 or 5 trades to build a full position. Full position means maybe max up to 3 to 4% of my cost basis, not the current value. But if I've invested $100 across all my stocks, probably invest $4 in this 3 max. Then, and that, like I said, I'm not gonna do $4 in one trade. I'll start with 50 cents, maybe add another dollar. I want to see the company perform, my thesis to work out, watch out for another quarter, and the business continue to do good, add little more. Or if the business is good and the market is just gone crazy, because of market can go crazy some days, then I'll bite and nibble a little bit. So that's why I'm done with PayPal. That's why I do with most of them. Is then max I will probably do 4% right now. I think it's 4%, or maybe I'll go to max to 5%, and then I'll let it ride. If it becomes 10%, 15%, because the stock has performed, I don't think I have anything right now, a single position which has become 15%, but I'll start to feel a little uncomfortable. I have not reached that stage yet. Maybe I'll see how do I let one position become 25%. I never have that. I'm much more comfortable with SPY being 15% of my position. But I hope I answered your question, Amit.
Yeah, very well. Thank you so much.
Cool.
I also
Right.
like that you use the cash position, so you don't take away from your winners.
Sorry, say that again.
I also like that you use your input or your cash, like your total incoming as a percent, so you don't take away from your winners, the
Yeah,
5%, 4%. Yeah.
yeah. So that was I started doing it in 2022. Is earlier I used to look at overall part of my current portfolio, and then I realized, if, oh gosh, let's say Mercado Libre has become much bigger, should I trim it? But I'm like, dude, the stock has performed. How much did I invest in it? So then I started tracking my cost basis, not just the invest in it, but there are many stocks which are good optionable. So I invest and also, basically reduce my cost basis. So I'm looking at my net cost, right? and then say, okay, if my net cost is only 2%, yeah, then maybe I should. And if the company is good, maybe I should buy more. Yeah. Pishan say, I sold Nanox. Will wait for it to come down to buy again. Yeah, I haven't increased my exposure. For me, it was if you sold it, great. I think it is now already down from 12.5 to 10. I don't know why it is at 10. And I haven't been able to find out when the next earnings is, because Tastyworks showed that the earnings was on 15th or 14th. But I went to the website, there was no mention of any earnings over there, which I find a little strange because they are due to report earnings. So, and again, this company has got zero revenue, almost zero revenue. So it's a moonshot. I don't want to add more to my position, but
Last
whether it will
earnings
come
was
down
on
again,
March 14.
I don't know. I mean, I can't time that. So I bought it and I have a covered call on it.
Vivek, the last earnings was on March 14.
No, I couldn't see anything.
Well,
I mean, that's
the
what,
bar chart says.
yeah, bar chart, and I think Nasdaq and this Tastyworks are picking from the same place. But I went to their Nanox investor relationship. There was no mention, and I was like, I was trying to find out.
Maybe they don't have any earnings to report.
So they have only, like, third quarter happened only in November. So beyond that, I didn't see. This was a November one, which I know, and after that, I've been okay. When are they going to report next? There's no information on it, which is little strange. I couldn't find any info under, maybe there's upcoming events will tell me there's a call. There is nothing related to that. Yeah, oh yeah, it's like 10.78. Again, this is like a very, very speculative bet, right? Instead of buying calls, this is my sugar rush investing in Nanox. Did you reduce your cash account? We'll see in end of March. I'll come back and share where's my cash account is. But I don't think, because I didn't liquidate my ICSH position, because I sold some, calls for hedges, and which gave me the dollars to invest. So I just use those dollars. And again, now from a Disney, I sold something, Disney stocks, because of my covered call was in the money. I really didn't want to chase it. I still hold Disney. I'm not completely out of it, but I think Disney has now become too many cooks in the kitchen, and probably, and it has worked out well for me. I think I bought it at average at 102 or $103 on, like, over last 3 years. Cost basis is around 80, and my covered call was around 110 or 100, something like that. So still 80, and letting go some of it go at 100. uh, Good deal for me. I still hold Disney, and I think I have another covered call at 120 or something. If it gets called away, I'll be done with Disney. Whatever you do, don't fall in love with the stock. Watch position size. Yeah, exactly. Watch position size, and don't sell your winners to fund losers. That is some area where I still have to improve upon. I mean, that's but human nature. The study shows, right, that the pain of experiencing a loss is 3 times more than the joy of experiencing a gain. So it's by human nature, you don't want to sell your losers, because then you've admitted that you're lost, and that admission is 3 times more intense than the joy of enjoying a game. So and I'm human, so I still have to work on that one. I noticed same about XDD for Broadcom. Okay, the dividend date. How do you keep track of a cost basis since you keep selling puts call to reduce cost basis? yeah, so I do track my positions. Almost all stocks have a greater than 60% run. Oh, of course. All good stocks. Amazon $97 to $6 or $90 to $6. Apple had 3 instances wherein they were down more than 70%. You can't go through these multi-baggers unless you have a wherewithal to go through these drawdowns, right? Same is the case with, let's say, this crypto stuff. So I had some of my friends congratulating me. Hey, Bitcoin hit all-time high. Great. I'm like, yeah, but the journey has been tough. Like, it's been multiple 80% drawdowns that you have to go through that. So you just make sure the position size is appropriate, that if you get 80% drawdown, you're still in the game. That's the one lesson that I've learned over years of investing is position size. That is the biggest lesson for me is position size. You can go wrong in everything else. You can pick up the worst stock, or you can pick up the stock at the worst possible time. You pick up the all times high and the market never recovers. You pick up the stock in which the management is corrupt, right? Anything you can do. But if your position size is appropriate, you'll survive. And I think in investing, surviving for a long term is what matters. Numbers show, right? Not trying to make extreme amount of gain, not trying to hit the ball out of a park every year. So if you see my style of investing, I'm becoming more and more conservative now, right? Because I'm not trying to chase the best returns. So if we are here to figure out which stock is gonna go 4x or gonna go double this year, I'm not even trying to chase that. My own perspective, I want to make sure that even if I can make 10-15%, but don't face huge drawdowns, that's good enough. That's good enough for me over a long period of time. So because I learned my lessons, and I'm trying to make sure that I don't have a huge drawdowns. If that means I have to sacrifice some of the upside gain, perfectly fine. All right. Shall we jump into some earnings? What else? Or you want to look at something else and earnings later? What else do I have? I got earnings. I got some news, some tweets. Okay, maybe let's go through this and then we'll go to earnings. So I think yeah. So last week someone told me that the Barron's has got a page on Mercado Libre. So I went through that. I've been in this company for some time now. What else? I don't know. I think they talked about their earnings. They talked about what the recent disappointment after earnings, which I thought was an overreaction, because the disappointment was their earnings was down, even though the revenue was nicely up, but the earnings got impacted. But if you dig into the details, and that's what algos don't dig into details, right? Algos will look at the number going, the EPS is down, and they'll sell it off. But if you look into the details, the EPS was down because of a one-time tax hit in Brazil. Number two, they're spending a lot more to build warehousing capacity. And they told that we will continue to invest because right now in Mexico, there's so much demand. That's why our warehouses are running over capacity. They don't want to end up in a situation where they have more demand and they can't deliver the goods, right? It's a e-commerce player plus e-commerce plus PayPal business. So their EPS has more than doubled last year and expected to climb 80% in 2024. What else? What else Barron's had to say? Yeah, I mean, they have had competition from Amazon, Temu, even C Limited has come to LATAM, but Mercado Libre has been able to not just survive, but thrive And if you go back and review the video on the earnings of Mercado Libre, you will see if from a business perspective, it's doing just fine. Like payments is like growing like crazy, and then they continue to put those numbers year after year after year. And, they did invested $500 million of capital expenditure for building these warehouses. Everything came from its cash flows. Right. And many rivals have now retreated from the region. When I read this, I didn't know which ones, but then I was also looking into Sea Limited. Now they told that they are scaling back their operations in Latin America. So then I realized, okay, it's Sea Limited is probably one of those. It's gone from a 5-player market, now effectively 2-player market, with Mercado Libre is number 1 and Amazon is number 2, somewhere very behind. What else? Customers are using that. Yeah, this is where what I like about their business, which neither Amazon does nor anyone else does, is that not only their payment system is being used on Mercado Libre's website, but even it is used on other merchants' website. It is used as a point of sale, at the point of sale, even on a physical retail stores. So, and that business, let me just maybe pull up a Mercado Libre, and that business is growing much faster. They call it as off TPV, is growing much faster than their on TPV. So because we got a bunch of new people, so maybe let's quickly, what else I saw it in 2024 earnings, right? Yeah, revenue was up 42%. Operating income, as you can see, was down 31% for all those reasons. Now revenue was up only 42% because it's they operate in Latin America, right? And last year, dollar has been strong. So dollar and the currencies in Latin America have devalued against dollar. So that does impact when they convert their numbers to dollar. So if we want to really look from how the business performed, foreign exchange neutral, revenue grew 83%. Gross profit was up 34%. If we neutralize the impact of foreign exchange, it was up 82%, right? We talked about operating income, why it was down. GMV was up 40%, foreign exchange neutral, 80%. This is their payment system, Mercado Pago. Total payment, number of payment transactions was up 80%. Payment volume was up like 57% in dollar terms, 153% in foreign exchange neutral constant currency terms. They have a credit business, which this is a little smaller business, still growing up. Envios is their logistics business, which is up and was up 45%. And they mentioned that we're going to do investments in new warehouse facilities and all that stuff. So, I mean, I'm pretty happy with the business as such. Prashant, how profitable is the retail business I don't think I have the number on the, hold on. Do they split up the profitability of the retail business? P&L, net revenue, commerce revenue. Yeah, so actually it grew 91%. Commerce revenue, which is their e-commerce, like $2.4 billion. Oh, sorry, that's a net revenue. Or no, that's a net revenue. Where's the profit? Or they don't break down the profit into commerce profit or the fintech profit. So we don't have that number. But are they profitable? Let's look at their, yeah, they were like 165 million, at least for this quarter, because they invested a lot more back into the business. So good to see, Barron's also recognizing that this is a, a winner in LATAM e-commerce space. And yeah, customers, hopefully, I think the stock has been to multiple places. It's been to 1900 during the peak of 2021, corrected back to now it's what 1500 or something. But I'm still okay to hold this. It does trade at a lofty 44 times earnings, so it is expensive. It's not a cheap stock, to be very clear. It is an expensive stock, but I think they continue if they continue to build the business like this, I'm okay to hold this for longer. Marisa said it's expensive. So if you want to do covered call, you need to own 100 shares. So there are other ways to reduce the cost basis. I don't own 100 shares of Mercado Libre. Like this is like what $1,400, $1,500 stock. So you really need to invest 150K if you want to own 100 shares. So what I do is to do a call spread. So then I can determine what kind of exposure I want. And maybe I'll do a $50 white spread, call spread on this one instead of doing a naked call. Because I earlier when I bought into Mercado Libre, I think my first time when I bought it, it was like 350-ish, between 300 and 400. And I did not have 100 shares. And I did a naked call, means partially covered because I owned some shares at 25 or 30% higher, right? And the damn thing jumped after earnings. It blew through my short call, so I had to sell some of my holdings and close that call. And then I learned I'm not gonna do uncovered or partially covered call on this one. And of course, that time I wasn't much educated around its business, but over the years, then I started following it up and started building position. And so now I will only do call spread and not what I call as a partially covered call. If you don't own 100 shares and you sell a call, it's a partially covered. Melly falling into support. Let's look at. I don't know where. So you can consider this again. Getting support and resistances could become very subjective. Don't beat me up because I'm not a big TA. So you can consider this as a support, because last time it bounced over this, and you can say maybe where 1470 could be a support. Now it's getting very closer to that. Possible. What if it goes through this? Is it going to be bearish? Who knows whether it'll bounce off the support or it'll go through the support. Right? So, but I mean, I find it at the overreaction from the market, because they announced additional $250 million investment into building warehouses in Mexico. Markets didn't like it, but I'm like, guys, they already told you they're gonna do this. so there's nothing new. So I'm like, okay, I'll still hold this. So that's Mercado Libre. If I look at going long, not really. Like it's still above lower Bollinger Band. CCI is still above minus 200, and RSI is still not below 20. Sometimes these might signal, okay, yeah, this is a good position starting. It's not like clear signal looking at all the three indicators. I don't know. So everyone follow their own indicators. I've tried a few. I tried a TTM squeeze. I also looked at a Keltner channels, in my real life. eventually I think nothing works perfect every time. So I'm not I don't wait for don't make huge movements based on what the chart is showing me, especially if I have a very long-term outlook for the stocks. So that's Mercado Libre. Any other questions? So Maritza, I hope I answered your question. You don't really need to own 100 shares, but I'll also put a disclaimer is it's a tough share stock to reduce the cost basis because the bid and ask spreads are really wide, and it damn thing doesn't decay much. So it's not easy to reduce the cost basis on Mercado Libre as it is with some of the other stocks that I've held in my portfolio. So this is a difficult one. And I think I've also said this earlier. It's the biggest position. My biggest worry is, oh gosh, I'm trying to reduce cost basis. This is not the best stock for options. But we got to do what we got to do. Okay, while you're there, could you demonstrate how you would enter a call spread? Okay, ready. Let me just build a position. Let me give me a moment. I'll just simulate a position, and then we can go through and see what I can explain what I meant. Okay, so we wanted to build a position in Mercado Libre. Give me how many, let's say, how many stocks you want to show in there. I think that the question was for Maritza. How many stocks do you say we should buy?
Since it's so expensive, just something as small as possible. Just
Okay,
to see how
so
you would enter it. I'm just curious, like where you would put your strike prices and how you would build it.
okay, so say says 1500, right? So I own only 50 stocks. Okay, so let's put it to analyze trade. There I go, own only 50 stocks at this current price 1506. Now, if this is my current position and I want to see, I need to reduce the cost basis on this one, what can I do? So I'll go and look at, because I don't own 100 stocks, and let's say we want to sell a call spread at 19th April. I actually have a position on 19th April. So this is what I'm going to do. I actually have a put spread on it right now because I want to acquire more. So I could come here and bought at 1500. And that's a problem because we are only now 34 days away. So there's not much of a premium, but you could 1700 and let's say this, right? Getting a $30 wide. Now I'll go through the thought process. You can pick up the strikes and make the changes, as you deem fit. But here's my thought process on this one. And so the call spread, which I did is this 1700, 1730, right? Which gives -3 deltas. So which is like, I own 50 shares. 3 shares is currently basically reducing the delta by 3. And if the stocks comes over to 1700, I'm at 1500 owning 50 shares. So that means per share is 200. I own 50, so I'm up like 10,000 on my stock position, right? And then another 30 here means another 3,000, another 1,500 on my stock position. So I'm like, worst come worst, if the stock ends up at 1,800 or like at 1,730, I lose $2,700 and 35 cents on my option position, right? Because the call spread will be full in the money. But I'll be gaining a lot more than that on my long stock position. And how you see the impact of both, actual think or swim tells you very clearly. So if it continues to go higher, my portfolio will continue to benefit, but my max profit will be around 1700. Then from 1700 to 1730, I'm not going to make any profit because that's where the call spread kicks in. I'm going to lose money on option. But this is my worst situation. In worst situation, I'll be making $88,480. Okay, I'll take it. Because if continues to go higher, my call spread is in the money, that's fine, but I'm still, have those 50 shares that will play, on this one, which will continue to benefit. So now you can draw in terms of what's your outlook is. You don't want to go all 1700, you're thinking, oh, that's too far away. I'm not getting much premium. And the bid ask spreads is really wide on this one. So if the position, let's say if it continues to go higher and you want to manage it, it's not possible to do it on the Mercado Libre. The managing the option trade is very difficult to do on Mercado Libre. Okay. So, and if you say, I don't think it's going to hit 1700, maybe I can become a little more aggressive and do 1650. And of course, you're going to get a lot more premium. And let's say I want to do 1700, I went $50 wide because that gives me $5.45 right away. Then I'll see, okay, you know what? Worst situation when the stock has gone through the moon is that my overall portfolio, worst situation will benefit only 5,275. The only thing in that time, you shouldn't have a remorse of, oh gosh, if I had not done this, I could have made $4,000 more. So that's how you build, or you can look at your various scenario and see what's your comfort position. This doesn't trade 60, 70. Okay. What's your comfort position? And how much do you think the stock movement could be? You could look at the deltas or whatever, whichever way you pick up your strike prices. But that's how I look at it and say, worst come worst, I'll end up making, instead of making 6,000 in this case, instead of making, I'll make only whatever 6,500 across my all positions instead of making 8,000, right? But still a gain. And if the stock doesn't reach all the way to 1650, all right, I reduce my cost basis by, $1.70 on, sorry, it will be like $3.4 per share. Do it again. So that's how I look at in the build position. Okay, helpful? Yeah, because there are many stocks like which are so big, you can't, I mean, you can, but many of like a normal individual retail investors cannot have 100 shares. In that case, I'll never go naked. I'll just sell a call spread against it and just plot it and see what's my maximum profit, what's my minimum profit, and when do those occur, and what's my probability of the stock hitting, that range. All right. So that was Mercado Libre. Since you bought Tesla, did you consider buying Rivian this week? No, I did not. Because I've not looked at Rivian. I mean, Rivian was another second company, which if I were to take more exposure to EV, US EV, but I haven't yet decided to add a new taker on my portfolio. So I don't look at Rivian. Okay, let's look at the, which stock was that? McDonald's, right? I mentioned I'll come back to McDonald's. Let me pull McDonald's data. So let's look at McDonald's. Alrighty, revenue up 8%. Yeah, it's a consumer stable companies. Can't expect it to grow like 20%. So up 8%, probably largely driven by inflation. 7% gross profit of 7%, gross margin 57%, nice operating income. I like that operating margin 43% with all the, it's not a software company, but its margins are like software company because they don't own, this, it's owned by franchises. Net income to $2 billion on a sale of $6.4 billion, which is very healthy. Nice cash and cash equivalents, $53 billion debt. Stock-based compensation, not much. They've been reducing their share count quarter over quarter. Operating margin mid-30s, EPS stable. Little expensive on the valuation side. Yeah, I love it. Like not much of a stock-based compensation. Have a real free cash flow. Only thing I worry is it's been okay. So let's look at the annual side and see. They're not that expensive. I mean, it has always been similarly expensive, trading at 23%. Yeah, so it's not too bad. And the numbers look fine. It's a company that will continue to grow at inflation rate. So I don't know what's your outlook was. Is it looking for you can't expect it to grow like 20%, 30%. But a decent return on invested capital, 9% revenue growth, 2021. Yeah, I mean, sorry, yeah. It's been not consistent. So I guess this whole 9% is probably coming from inflation. Look at the others one. The revenue had been declining. So that does give me a little bit of a concern that over past many years, their revenue actually had been declining. And maybe in 2023, it got boosted, I guess, because they were able to raise prices because of inflationary pressures. But even if they don't grow the revenue, I think they have a decent amount of a free cash flow and they have been buying stocks. So from I mean, it's not too much of a risk in this one, but it won't be growing gangbusters. That's my quick update on, I don't know who, somebody had asked for MCD. Again, I don't know much about business. I've never looked into this. I've not looked at, competitive threats and all that, but I'm right now just looking at the numbers and I'm seeing how management is allocating capital, what are they doing with their shares, balance sheet, operating margins, EPS, and some trends. Right. So that's MCD. This detailed spreadsheet from a stockanalysis.com. I pulled the data from there. All right, few more charts on, and then we can get into, after this, we can get into remaining earnings. NVIDIA versus Cisco. Like I said, are we in 1995 or are we in 2000? Some interesting charts. So I thought I'll share here. From 314 Research, that's a pie. According to the tech bulls, NVIDIA has a runway compared with Cisco in 1990s. Come on, look at how much has Cisco ran up to, whereas NVIDIA is only here. So there's a lot of a bull run still remaining. But if you look at NVIDIA as a percent of S&P market cap versus Cisco as a percent of market cap, we probably are already in bubble. Right? So this says maybe 1995, this says, oh no, you're already in bubble, right? NVIDIA became 5.1% of S&P market cap, whereas Cisco at its peak was only 4.5%. So it's already too big, too concentrated, right? We can skip this. Another one I read on Bloomberg, and they looked at a different metrics. So if you're looking from an earnings multiple, like their PE multiple, especially forward PE multiple, then looks like NVIDIA already had its bubble, and that bubble already burst, because we'll know that NVIDIA at $800 is cheaper than NVIDIA at $300 when you look at earnings multiple. So what Bloomberg says is, guys, NVIDIA already had its moment where from an earnings multiple perspective, it was way more expensive, and now it has become cheaper. So the bubble is already burst, right? But if we're looking at sales multiple, right? Oh gosh, yeah, we're not there yet. From a sales multiple perspective, we are still in bubble and had yet to be burst. Okay. Another viewpoint, looking at the growth that is, Cisco growth trajectory was like this, and now NVIDIA's is like, boom. Is this even sustainable? Of course not. So looking at this chart, it looks like, guys, and I don't think this is sustainable. So maybe we are in 2000. And yeah, so that I thought I'll share some few charts, because this has been a big debate around NVIDIA versus Cisco in FinTwit on, are we already on the peak, or are we just getting started? I still don't know where exactly will it be. That is why I've done what I've done with my shares. I'll hold the remaining ones in portfolio to, if it continues to go higher, to enjoy that. If it goes down, I'll have a consolation of, okay, I sold and some of it at a higher price. Paul says, notice that Cisco did the same things that NVIDIA is doing, investing in small unheard of companies, getting them to place order for chips. Cisco did that with networking equipments. So I don't know how it is when NVIDIA is also, which is right. And it is probably legal, but on borderline and on ethical is you having, I mean, same thing Microsoft did with OpenAI, right? They invested in OpenAI and then circled back and gave credits to OpenAI to use $10 billion worth of Azure. I mean, these companies do this all the time. I think in technical term, this is called what, vendor financing. You basically pay money to vendor, and they come and buy your product, or something like that. Yeah, it is not illegal. It is not illegal. I guess lawyers have all figured that out. They probably want to stay clear of any legal issues, but yeah. NVIDIA has invested in upcoming AI companies, which would basically use NVIDIA chips. And even I think outside of that, still there is a lot of demand of chips from Meta and other companies. My only worry is, when are they going to see the benefits? Not NVIDIA, but let's say Meta, etc. Cisco went bankrupt because Cisco's customers did not, not other way around. Cisco didn't go bankrupt. Cisco's problem was Cisco's customers started to go bankrupt. They didn't see the demand for which they built the whole infrastructure. So now they suddenly had a huge networking gear which is not being being utilized, and many of the orders, they just backed down on it. So the Cisco's customers didn't see the benefit, and hence the valuation was already like accounted for unlimited kind of a growth for years to come, didn't pan out. And again, I wasn't in my experience or whatever I'm saying is only from reading what happened. I wasn't even active in the market at that time. We have yet to see the benefits of AI being accrued to these companies. Uh, Microsoft, Meta, Google. So it's I think it'll take another year for them to figure out, gosh, we invested billions of dollars. Where is the ROI of it? Right now, all the investment is based on story. It has to be backed up by numbers at some point of a time. Now, that may not be a month or 2 months or 3 months down the line, maybe a year down the line. I think that's where the challenge lies, when that time of reckoning will come, wherein say, guys, you invest in billions of dollars in AI, where's the dollar? Where's the money? So when that reckoning will come, then we'll realize, okay, we probably thought it's got a endless demand, no longer. All right, what else I have? Yeah, okay, another one I just want to share. I was listening to a podcast wherein Dan from Poland Capital gave a very nice framework, which you and I, anyone can use, and not too many parameters, is to find some good quality compounders. And they've been able to compound their asset under management of around 14% year over year for decades. So that the record speaks for itself. 5 things that they focus on: cash rich balance sheet with very little debt. If it has debt, it should not be more than 3 times free cash flow, so that they can pay off their debt in 3 years without raising any money, just through the cash flow from their operations. Should have excess free cash flow every single year, not just 1 year. Sustainable return on capital about 20%. Stable to increasing profit margins. Organic revenue growth on the higher side for its industry. And this asset management firms operate globally. And they say, out of all the global companies, there are hardly 350 companies that meet all the 5 criteria that they have. And they're pretty strict about, investing only in the company that meet the criteria. And throughout this lifetime of the fund, this is basically their growth fund, they invested only in 130 companies. Today, I think they have around 22 companies, between 20 and 30 companies that they currently hold. But I found maybe, pretty good criteria to look at. If you were wondering, why should I invest? Which company should I invest on? You want to be on a safer side. And you may not get all the sexy companies or all the, fashionable companies that is being talked about in Twitter or in CNBCs, because many of them don't make any money. So your profit margins, that criteria, you just don't meet it. Many of the companies leverage debt to shore up the return on equity, right? Look at all these telecom companies. I mean, nothing wrong in there. This business model is, guys, we got a predictable cash flow coming in because we got a number of subscribers and they don't change. I mean, there is some ups and downs will happen year over year, but it's fairly predictable revenue stream. Same is the case with utilities. And then they are okay to take a lot more debt and finance their operations through debt so that they can shore up the EPS. But, at least this manager won't look into that company. So I thought I'll just share with you guys. In case you're looking for, having your own framework for how do I find some good companies. And again, different managers have different criteria depending on how they build their portfolio. So I'm not saying this is the holy grail, but it's always good to look at what other successful investors are doing. I haven't heard of any and I do hear to a lot of podcasts, a lot of long-term investors. I haven't heard any one of them talking about trying to time the market. I think the people who can time the market only exist in YouTubes and Twitters. No successful investor ever talk about timing the market, and not them talking about what the market's going to do next 6 months, or how the Fed is going to do that. They base their decision on what the Fed is going to do. Right? So more and more I spend time in understanding and focus on investment, more I realize that many of the things that I used to do are just not needed. Sometimes you feel too good about trying to do too many things, but eventually doesn't make a big difference in long term. Any good podcasts you recommend? Oh gosh, I have many of them. Hold on. I think, let me pull up in one of our sessions, I listed on all the podcasts that I had, and I think I added a few more after that. But one which I'll recommend is, especially around if you are interested in listening what other investment managers do, is a John Rotonti's podcast. This is what I tweeted. It's a J-Ro Growth. It's called J-Ro Show. So he's an ex-analyst. I mean, he was an analyst with Motley Fool. The reason I follow him, he got me into ASML. I really looked at his thesis of ASML 2021-ish. And then I'm like, no, that looks to be a great company. And then I started following the company, and now ASML is one of my top 10. So I started following John Rotonti since then. And he very recently started his own podcast. He left Motley Fool, started his own podcast called J-Ro Show. He brings in some great asset, investment managers from firms. They talk about their investing process, their frameworks, how the analysts go about, finding good companies, etc. So that's one I'll recommend. Maybe next week I can bring up a list of other podcasts that I listen to. All right, let's go back to okay, that's much bigger. Maybe go next time. Let's finish it up with a little more earnings, and that'll be all for today. There we go. Okay, I think this is a little older. CrowdStrike did it a week, not this week, but a week prior. Is ARR was up 34%, subscription revenue up 33%. What I like to see in CrowdStrike is what's happening over here. How many customers are buying more and more modules? The reason is you incur your customer acquisition cost, CAC, once to bring customer onto your fold, or you get your foot in the door of a customer, and then you can keep upselling more and more modules. So I wanted to see how many customers, and customers will generally start with one, whatever, 3, 4 bare minimum modules. And if they like the company, they like the service, then they will say, okay, you know what? Yeah, I'll buy some more services from you. And that means all the additional services are basically coming at a very low cost of sales. They add directly to your margins. So I do want to focus on what's the growth of customers which are using 5 modules, more than 5 modules, more than 6 modules, or more than 7 modules, right? So good to see there that 64%, 43, 27% of customers use 7 modules. Quarter summary, revenue is up 33%, gross profit up 38%, gross margin is 75%. Which is great. Operating income was up like 148%. So net, I think everything was good on CrowdStrike, but it wasn't as good as like 30% jump, which it got after I would say, the earnings. So I don't know. I mean, I think that it deserved a 30% jump, even though the quarterly result was okay. Operating margin a huge jump, EPS increased, share outstanding continue to increase, which not good. Balance sheet is fine. We talked about this. Subscription gross margin is near 80%, which is good. And 10 continuous quarter of real free cash flow. Right? Not the free cash flow from stock-based compensation, what like Reddit is doing, but real free cash flow, 10 continuous quarters. They also agreed to acquire a company called Flow Security. I want to find out what's the details of this and how are they financing it. What else? I think this was a little tongue-in-cheek. We took a shade on Palo Alto Network because Palo Alto Network told that customers are suffering from budget fatigue. And this is what CrowdStrike CEO George Kurtz had to say, is it is a customer trapped in stitched together pseudo platforms that are suffering from budget fatigue, not CrowdStrike. And if you followed Palo Alto, you know that Palo Alto was not natively built for cloud, but they bought on a lot of acquisitions. They did a bolt-on acquisitions. And I don't know, I mean, Nikesh Arora came and told that that they want to move towards platformization and customers are having budget fatigue, but CrowdStrike said, guys, we built as a platform. They don't have to move. They were born as a platform. Anyway, pretty good. I'm a whole shareholder of CrowdStrike. I'll still hold, keep my shares. SentinelOne, similarly in cybersecurity space, SentinelOne it competes with CrowdStrike, but it at a lower level. Lower level means while CrowdStrike is focused on a bigger enterprises, of course, they recently also brought up a product for small and medium business segments, but majority of the revenue is still coming from bigger accounts. SentinelOne focused on the small and medium business segments, so on the SMB side. Their platform is called Singularity. Let's look at the numbers. The revenue was up like 47%, which is good. Gross profit is also 56%. Operating income, even though negative, was still up 7%. Little improvement on operating income. Margins are all negative, 60%. I don't like that. Net income, I mean, no net income, no operating cash flow. So market really liked the result because I think they beat the top line as well as bottom line. So I guess it was just the case that the expectations was so low that, the 47% and the operating margin, operating income of, I think it was net income. They beat on both. So market really liked it. I don't have any positions, and at this point of time, I don't want to open any position on SentinelOne until they, clean up their margin profile. So yeah, so they beat on EBITDA as well as on guidance. But I guess between CrowdStrike and SentinelOne, I'll still rather be a holder of CrowdStrike. But I'll watch this. I used to have this in my portfolio, during the heydays of 2021. But then when I spent time in 2022 in cleaning up my portfolio, this one got the X. So, but looks like it is back on nice growth. But I want to see a margin profile improving. All right, next one, Oracle. Let's look at the quarterly numbers and then the yearly numbers. So 7% increase year over year on quarterly revenue. Gross profit is up 5%. Good gross margin, 71% gross margin, 28% operating margin. Net income is $2 billion on sale of $13 billion to $2.5 billion. 5.4 operating cash flow. So yeah, I mean, here is where the magic was for Oracle, the cloud services. that grew 25% year over year. I think everything else is fine. So they beat the earnings estimate, and the cloud revenue grew, even though the overall revenue grew only 7%, it was a cloud revenue that grew 25% year over year. And the cloud infrastructure revenue, which is their, like you got Azure, you got a GCP, you got the third one, AWS, the biggest one. Oracle has got an OCI, Oracle Cloud Infrastructure, that was up 49%, and market really loved that. So stock was up nicely 12% for three reasons. Number one is their infrastructure revenue grew 49% year over year, means this could, if it continues to grow at the same pace, it could become, the formidable competitor to the other three cloud providers. Instead of a three, we may be talking of big fours. But right now, the revenue is still very low, $1.8 billion, which is like maybe 15% of their revenues. It's not a huge part of their revenue yet. But if it continues to grow at 49%, whereas the rest of the company is growing at overall at 7%, it could become much bigger. I have to go and look at how Azure had grown and what was Azure's trajectory. And then maybe we'll be able to see, if it, are we like buying Oracle at this point? Is it like buying Microsoft in 2014 or 2014, 2016? Or is it, they should have had more revenue under this? So that was one reason. Another reason was the RPO. So remaining performance obligations, a technical name for what you could call as a backlog. So that was the new company record of $80 billion. So that means, so these are the RPO is nothing but the contracts that have been signed. So generally these companies will have a multi-year contract. So you could have signed a contract with Oracle to perform a services for next 3 years. It's a 3-year contract, but which is, let's say, worth $80 billion. But in this year, I'm only going to perform services 1/3. So revenue, I will only recognize 1/3, but the remaining part, which is 2/3 of that contract value, goes under RPO. It means I'm going to recognize the revenue from this bucket next year when I perform the services. So keeping an eye on RPO gives you some visibility into what's the revenue profile for next year's look like. Right? And when Oracle reported that they have hit the highest RPO ever in a company's history, that was really bullish. It means a lot of this RPO will be converted into revenue as they perform the services for the customer next year. Right? The third reason is the comment from a CEO saying that Oracle Gen 2 AI infrastructure demand significantly exceeds the supply. Again, that's an AI play. And when you come and talk about saying, guys, the demand for our AI infrastructure is way more than we can handle, like what NVIDIA has been saying, and then market loves it. So I think that those are the three reasons. Overall, Oracle Cloud grew 25%, 49% OCI, 49% OCI, RPO $80 billion all-time high, and demand for Oracle AI infrastructure significantly exceeds supply. That means this business will be in a hyper growth phase for time to come. And market like, wow, I love it. Like stock up 12%. It's now all-time high. So then looking at where's that? Or if I look at the Oracle's numbers, or year over year how they have performed, where's my yearly number? There's a quarterly. Oh gosh. Okay. So even if I look at their quarterly numbers, I mean, over the last few quarters, I think it's a decent company. Now the right now the market is excited about its AI play, and I think the majority of this $80 billion is probably because of their AI. So how long that AI will continue, that we have to see. But I do want to keep an eye on their cloud infrastructure of $1.8 billion. That for me in a long term will be bigger factor to determine if I want to pick up Oracle or not. But pretty good, I would say, quarter for Oracle. All right, last one, Adobe, that moved the markets. Revenue this quarter up 12%, gross profit up 12%. I love that. Gross margin is 87% gross margin. Operating income is up 16%. Operating margin 34%. Net income is up 26%, $1.4 billion. A lot of numbers. Net summary for me when I'm looking at that. So they beat both on top and bottom line, but they came a little light on the guidance, and market didn't like it. I think what Mark is thinking is a lot of these new and upcoming companies in AI is eating Adobe's lunch when it comes to generating videos and all that. Now we got a Sora, right, which can generate videos with the text prompts. We got so many image generating, yeah, so many companies which basically will generate image from text prompts. Even though Adobe has this Firefly, and they have a guarantee for their customers that they are using licensed or their own images, so you don't have any concerns about getting sued because you used unauthorized content. Basically, you plagiarize someone else's content to train a model. Who cares? I think so. Right now, based on the guidance, market thinks, gosh, it's AI for Adobe is not going to be as beneficial as what they had thought earlier. So Adobe was down big time after earnings. It's down 15? I don't know. I don't own Adobe. ADBE. Yeah, it's closed after down 14% after earnings. So, but if I look at the Adobe as a company and saying now it's down 14%, is there something that I can maybe see if should I take a position on it or not? So let's look at from that perspective. It does generate free cash flows. Liabilities are $5 billion, and 3 times of free cash flow will just take care of these liabilities. So from that perspective, good. Share-based compensation, not too bad. It's less than 10% of the revenue, not like some of those, not like Snap or Reddit, which gives 30% of the revenue goes as a stock-based compensation. Good return on invested capital and pretty consistent, high 20s. Revenue growth, not through the roof, but mid-teens. And share outstanding have been decreasing, so they've been buying back a lot of shares. So from a business perspective, to me, it looks like just a fine business. Now, the issue is the stock was super expensive, trading at a 50 times PE and 14 times sales. So I think stock correction was, hey guys, if you're not going to grow at the same pace, probably that was a correction. But I love, looking at summary of these charts is consistent growth in revenue, stable operating margins, EPS stable, even though stock-based compensation has been increasing, but percent-wise it's like it's like 10%, less than 10%. Shares outstanding is reducing. So even though they've been issuing more shares, they've been buying back a lot more. So overall shares outstanding is still reducing, which I like it. They have some real free cash flows, even if account for a stock-based compensation. So it's a solid company, but it was expensive from a pricing perspective. It was expensive and had to correct it. So if I were to initiate a new, again, not for financial advice, I don't want to add any more ticker right now in my portfolio, but this will be on my consideration list, especially that now it is becoming, trading 14% down. So I guess that's it. It was just, I would say, high expectations. But otherwise, the business looks to be, this looks to be a good company. Look at this. The revenue grew 12% in this quarter, and the market cap was up like 70%. So now if your expectation is going low, there has to be a correction. So I guess that's happened. All right, that's it for today. That was the last earnings. I wanted to quickly go through it. I see a question or a comment from Maritza. I'm a high-tech recruiter and many clients seem to be implementing SAP versus Oracle for EIP, but doesn't a big play in the cloud. Yeah, so SAP, I have had in earlier part of my career, I was managing some projects because my company was implementing SAP. Some other clients many years ago. But SAP have had its own issues. Now, last 3 years, SAP is trying to pivot towards cloud with SAP for HANA. And I haven't been tracking how they've been doing, but my understanding was like they kept on pushing the dates on which they will be migrating all their customers to SAP for HANA, which is their cloud offering. And if they have been doing good work over there, probably they're gonna go through the same trajectory that Adobe went through when they transitioned from licensed to a subscription-based revenue. Right? Every time you move the switch from a license to a subscription-based revenue, you will see a drop in your revenue, and market will just freak out saying your revenue is dropping. Of course, because instead of recognizing all the license upfront, now you're recognizing only based on what's been consumed in this year, right? So you will generally see the drop in revenue, saw in Adobe, saw in SAP. Even I think it was another company was, I think, Splunk. They went through the whole same process of being an on-prem software only to a subscription-based cloud offering. So I haven't tried SAP. Where is this? And what's the latest? Last I had was like 2027 is when they gave, not 27, 25 or something. They kept moving the goalpost.
Vivek,
Yeah.
my friend 25 years ago learned SAP at Cal State Chico. One of his classmates or teammates became very wealthy because he brought the platform to Taiwan. But he said the problem with the SAP at that time was too much upper management German bureaucracy. Do you have any ideas?
All I know is when I started my career, SAP consultants used to mint money like anything.
Yeah, that's when he learned. But unfortunately, his wife wanted him to stay in the U.S.
Yeah. Yeah. So, it's a German company. They have their own way of operating. So I have no opinion around the bureaucracy or anything around on the operations of SAP. But I know, SAP projects used to be worth millions of dollars, right? Any implementation will take 12 months, 18 months, and if you're lucky, you'll get it done in 2 years. There's a stat around SAP is for every dollar of a license revenue, the product license revenue, they used to make some $150 plus of a consulting revenue because it's so damn difficult to implement, manage, and maintain. So I guess when all these cloud-based companies started to offer a little more lightweight ERPs, yeah, it got a challenge. But looks like they have been able to pivot.
Hey
And-
Vivek,
yeah,
Prashant here. Can I take a shot at the question?
sure, go ahead.
Yeah, basically I come from an SAP background, bread and butter for me. So, um, okay, so SAP in terms of in history, if you look at SAP, it's primarily a manufacturing-based ERP application. The strengths were mainly into manufacturing, logistics, commercial activities. The business model over a period of time has been changed, and although SAP has been very slow in adapting the changes, if you look at their current offering, with a RISE platform, um, they are completely changing the game. What you said is absolutely right. Generally, SAP's implementation is to take years. Now, with a RISE platform and some additional features, and then tying with GCP, so they realize they have to kill Oracle, right? So they were been using Oracle hard database for a long period of time and Oracle services, and now Oracle, all of a sudden they realize, hey, I am indirectly selling my own competitor product. So, although they address the problem through S/4HANA, the HANA database, but they realize they are not very good in the cloud. So, the best way to address your competitor when you don't have your strength is to patch up with someone else who has that strength. And they're now going through an Google GCP. So, SAP is, I can tell you, is selling this services so damn cheap with Google that mid-size and small companies can easily see a great benefit. I know you talked to Oracle and said that Oracle is growing so fast and cloud and other services, but being in a market, I can see there's a big threat, especially from Google, GCP, because Google is really, really selling those in a really damn cheap price. Almost like close to $0, to be honest with you. Again, this is because we, company like us, we're saying, hey, I know it's a big risk to change the platform from Azure or Oracle to go to GCP, but there is a huge benefit. This is like kind of a $0 cost to me. Why don't I take a chance? Right? And then all those leadership teams whose bonuses and other things is based on saving the cost, they are tempted to kind of look at and then say, hey, why don't you take a chance? Let's go ahead. Look, let's go ahead and SAP with a GCP. Why not? So long story short, although SAP has been very slow in terms of providing a value and services of an implementation, they now come up with a better ways, and I think it has more better chances to survive and thrive in future. Sorry for the background noise. I'm outside.
No, I appreciate it. So thank you. Now we are hearing from the experts. So that's the beauty of this college. We get to enrich ourselves from a different viewpoint. So thank you, Prashant, for all your inputs. And yeah, I know you've been SAP all along. All right, I guess that's it that I had. Anything else? But I wasn't aware. So it means if SAP is going through the GCP, might as well that bodes well for Google, because they've been trying to catch up to Azure and AWS. Cool. Okay, I guess that's it for today then. Thank you, everyone. Thanks for joining in, and I'll see you next week. There are no questions. Cool. All right. Looks like that's it for today. Bye, everyone. And hope to see you next week. Hope you like it. If you have anything specific topic that you want me to cover, do let me know. All right. See you later.